do we go about helping buyers then that are basically participate in creating this transferable value? So we got this management team that has done the work. The owner has given them responsibility, and now we want to reward the management team with something that would be a piece of the action. So what I have up here is, this is a way for us to create some form of reward. That reward could be cash or equity. And so when I say cash, it'd be when the reward is paid out, and then the participant receives cash, and then either A, they're using it to get the bank financing, or B, we're giving them equity, which would be ownership, stock, that they may be using cash to buy along the way. But either way, we're ultimately trying to make them become more bankable. And so there's the reward that's for, we'll call it buyout, which would be tied to our desire to get bank funding when we basically achieved this level of responsibility on the seller's part. So we've got low responsibility. We want to do a buyout. We need to create some equity or cash for the buyer. The bank's looking for certain outcomes. And then we're targeting the plan so it meets the needs of the bank and the buyout. And typically what the bank is looking at for financial ratio starts off with, in my experience, the debt service coverage ratio, which is the ability for the business to service principal and interest with after-tax earnings. And typically what a bank that I've seen is 1.25 to 1.5 of after-tax profit. So they need $1.25 to $1.50 of after-tax profit for every dollar of principal and interest. So in the design of a incentive plan for the participant, where the company's saying, we are going to put some money aside for you in an account that could be tied to the business value or tied to an interest rate. At some point in time, we're going to pay that out to the key employee per the agreement, and then they're going to use that money to buy in to the company. So we design these if it's going to be cash, we design these deferred compensation agreements, deferred bonus agreement, that is tied to the exit path and the timetable that we're seeking based on the goals that the owner had is when they want to be out. If it's for a reward, is for incentives. Let's say we've got some people that we want to keep through the transition, whether it's to sale to outsiders or sale to management, who won't be part of the buyout if it's a management buyout, and we want to do something for them. Then what we do is we come up with a bonus agreement, build an account for them, and it could either be tied to the sale value. That's typically for a third-party sale, or it's tied to some target value based on what the key employee said they wanted. So in past, for clients who are looking at selling their companies to outsiders, they've had us interview the key employees that were driving tremendous amount of value, but had yet to be given anything that would compel them to stay with the organization through a change of control. So we put in place these stay bonuses that are designed to reward the key employees based on the sale proceeds that we got you know, in the valuation of the sale. And then they were able to then use those proceeds to go out and do something with. For example, I interviewed some really high performing salespeople and asked them what it was that they would like to have happen if the organization were to be sold and there was going to be a change of control, and what would they want to have happen that would compel them to stay. And the significance of this conversation was that these salespeople represented probably 30 or 35% of the earnings, the gross margin of the company. 2 people, and this is a $80 million business. So we definitely couldn't afford to have those guys walk away, because then the value would run out the door with them. So we interviewed them, they told us what they want, and we came up with the target value that was basically defined in the agreement. So when we do these plans where the companies are setting money aside for a key employee and building an account, and then we have an agreement, we are either doing it to reward them to participate in the buyout, and then we create a deferred comp plan that is specifically paid out when the buyout's going to occur. And we've come up with a way to get around some of the rules in 409A that allows for the money to be available very flexibly, but it's tied to specifically a sale. And then for those who are just trying to keep key employees on the team through a transition who aren't going to be part of the buyout, then we tend to either A, ask them what it is they want, or B, we use psychographics to figure out, you know, based on their compensation and their employment history, what percentage of their compensation would we need to have available to them at a sale in order for them to be willing to stay. So those are the 2 aspects of these deferred bonus plans.